Welcome to Farmtips Diary. Land is farming's oldest question. Own it or rent it. That choice has determined which farms survived the Great Depression, the 1980s crisis, and every downturn since. Today, we're exploring how ownership versus leasing strategies shaped farm survival across a century of economic chaos, and what the smartest farmers are doing now to build resilience in an uncertain future. When the ground beneath you shifts, land represents more than dirt and crops. It's wealth, security, identity, and often the difference between survival and collapse. But land also represents leverage, risk, and vulnerability. Understanding this duality means understanding agricultural economics at its core. During the Great Depression, land ownership became a double-edged sword. Farmers who bought land in the prosperous 1920s borrowed heavily, assuming prices and crop values would stay high. When commodity markets collapsed in 1929, those mortgages became anchors dragging farms underwater. Land values plummeted by 40 to 60% across much of the agricultural heartland. Farmers who owned land outright or with minimal debt could ride out the storm. Their land couldn't be seized. They produced food for themselves and waited for markets to recover. But heavily leveraged owners faced foreclosure. Banks seized farms, evicting families who'd worked the land for generations. By the mid-1930s, thousands of farms transferred from families to banks to auction buyers at pennies on the dollar. Meanwhile, tenant farmers and sharecroppers faced different pressures. They had no equity to lose, but also no asset to fall back on. When they couldn't pay rent, landlords evicted them. They moved from place to place, seeking arrangements, often accepting worse terms with each move. Neither extreme ownership nor complete landlessness proved ideal during crisis. The 1980s farm crisis replayed this drama with modern variations. Land values soared through the 1970s, driven by grain exports and inflation fears. Farmers borrowed against appreciated equity to expand. Land worth $500 per acre in 1970 reached $2,000 or more by 1981. That paper wealth felt real, and lenders treated it as collateral for enormous loans. Then values crashed. Land that peaked at $2,000 fell to $800 within 5 years. Farmers who borrowed $1,500 per acre suddenly owed nearly twice what their land was worth. They couldn't refinance because collateral was insufficient. They couldn't sell because proceeds wouldn't cover debt. They were trapped. Those who survived the 1980s typically fell into two categories. First were farmers who owned land with little or no debt. They weathered income declines because debt service didn't consume their cash flow. Second were farmers who leased most of their land. When crisis hit, they renegotiated rents downward or walked away from uneconomical leases. They maintained liquidity because capital wasn't locked into depreciating assets. The pattern across both crises is clear. Moderate ownership with conservative leverage provides stability. Heavy ownership with excessive debt creates catastrophic vulnerability. Leasing provides flexibility but less long-term wealth accumulation. The optimal strategy depends on economic conditions, individual risk tolerance, and stage of farming career. Asset-heavy versus cash flow-driven models. Modern farming splits into two distinct financial models, each with different risk profiles and requirements. Understanding these models helps farmers choose appropriate strategies rather than defaulting to conventional wisdom. That ownership always beats leasing. Asset-heavy farms prioritize land ownership and accumulation. These operations view land as the foundation of wealth and security. They borrow to buy land, often leveraging up to 60 or 70% of value. Their balance sheets show millions in assets but also substantial debt. Annual cash flow goes heavily toward debt service rather than operating flexibility. These farms bet that land appreciation will outpace debt costs over time. Historically, this often worked. Land purchased at $1,000 per acre in 1990 might be worth $8,000 today. That appreciation creates enormous paper wealth. But this strategy carries significant risks during volatile periods. When land values decline, asset-heavy farms face immediate pressure. Loan-to-value ratios deteriorate, triggering lender concerns. If values fall enough, farms become insolvent on paper, even if operationally profitable. Refinancing becomes difficult or impossible. Equity lines of credit get reduced or eliminated. The asset that was supposed to provide security becomes a liability. Additionally, asset-heavy farms sacrifice operational flexibility. Most capital is locked in a liquid land. When opportunities arise to invest in new equipment, technology, or alternative enterprises, capital isn't available. When downturns hit, there's no cushion. The farm must service debt regardless of income, forcing operators to drain reserves or borrow more just to survive. Cash flow-driven farms take the opposite approach. They lease most of their land, sometimes farming thousands of acres they don't own. Their balance sheets show fewer assets but also minimal debt. Capital stays liquid, deployed toward equipment, technology, inventory, and reserves. Annual cash flow focuses on operational efficiency rather than debt service. These farms bet on their management skills and operational excellence rather than asset appreciation. They can scale up or down quickly based on market conditions. If grain prices collapse, they reduce leased acres and cut costs immediately. If opportunities arise, they have capital to pursue them. They maintain flexibility that asset-heavy farms lack. However, cash flow-driven farms sacrifice long-term wealth building through land appreciation. Rent payments build no equity. When operators retire, they have less to pass to the next generation or sell. They depend on continuous operational profitability rather than accumulated assets. And they're vulnerable to rent increases that can eliminate profitability during difficult markets. The reality is that most successful farms blend these approaches. They own some land, providing a stable base, while leasing additional acres for flexibility. The ratio depends on individual circumstances, but the most resilient operations typically own 30 to 50% of farmed acres and lease the remainder. This combination provides both stability and flexibility. How modern forces reshape the equation. Today's farmers navigate land decisions in an environment shaped by forces previous generations never faced. Understanding these forces is essential for making sound choices about ownership versus leasing. Inflation fundamentally changes land economics. During high inflation periods, hard assets like land preserve value while cash loses purchasing power. The 1970s demonstrated this. Farmers who bought land before inflation accelerated saw asset values rise faster than debt costs. Those who held cash or avoided ownership watched inflation erode their purchasing power. But inflation also increases operating costs, squeezing margins. Fuel, fertilizer, seed, and chemicals all become more expensive. Highly leveraged landowners may see their land appreciate while simultaneously struggling to cover debt service from squeezed operating margins. The asset gains don't translate to operational cash flow. Interest rates interact powerfully with land values. Low rates make borrowing cheap, driving land prices up as buyers can afford larger loans. When rates were near zero in the 2010s, farmland prices soared because financing was affordable. When rates rise, the process reverses. Higher borrowing costs reduce what buyers can pay, depressing values. This creates timing risk for buyers. Purchasing land with cheap credit seems smart until rates rise, values fall, and the loan becomes burdensome. Farmers who bought land in 2012 at 3% interest felt brilliant. Those who bought in 2021 at similar low rates now face a market where land values plateaued or declined while their debt remains. Land speculation by non-farm investors adds complexity. Investment funds, wealthy individuals, and foreign buyers now compete for farmland. Viewing it as a portfolio asset rather than operational necessity, this competition drives prices above what farmers can justify based on production income alone. When investors treat farmland as a financial asset, prices disconnect from agricultural fundamentals. Land that generates $300 per acre in net income might sell for $12,000 per acre, implying a 2.5% return. That only makes sense if buyers expect significant appreciation. Farmers who compete at these prices often overlever, assuming appreciation will bail them out. Tax policy influences ownership decisions substantially. Property taxes, estate taxes, and capital gains treatment all affect the economics of ownership. In regions with high property taxes, leasing becomes more attractive because owners bear that burden. Estate tax planning drives some landowners to sell rather than pass land to heirs, creating opportunities for buyers but also family disruptions. Climate change introduces new uncertainty around land values. Areas experiencing increased drought, flooding, or extreme weather see land values reflecting that risk. Farmers must consider not just current productivity, but long-term climate trends when making ownership decisions. Land that was prime may become marginal, while previously marginal land might improve. Knowing when to buy, lease, or sell, the decision to buy, lease, or sell land should follow strategic principles rather than emotional attachments or conventional assumptions. Different situations call for different approaches. The best time to buy land is when most farmers can't or won't. This typically means during or shortly after economic downturns when land values are depressed, credit is tight, and pessimism prevails. Buying during peaks when optimism and credit are abundant almost always means overpaying. Before buying, Calculate sustainable purchase price based on production potential, not market comparables. If land can generate $250 per acre in net income, and you require 6% return on investment, sustainable price is roughly $4,000 per acre. If market price is $8,000, you're speculating on appreciation rather than investing based on fundamentals. Buy with conservative leverage, ideally below 50% loan to value. This provides cushion if values decline and ensures debt service remains manageable even during low-income years. Pay 20 to 30-year fixed-rate mortgages to lock in rates and match repayment to land's productive life. Buy when you have strong cash reserves and operational profitability. Land purchases should enhance an already solid operation, not rescue a struggling one. If operational margins are thin or reserves are low, improving operations or building capital should take priority over land acquisition. Leasing makes sense in multiple scenarios. For beginning farmers, leasing provides access to land without the capital requirements of ownership. This allows starting operations, building experience, and accumulating capital before eventually purchasing. For established farmers, leasing additional acres enables scaling production without the leverage risks of buying. Lease when land prices are inflated relative to production potential. If purchase prices imply returns below 3% annually, leasing at $150 to $250 per acre often provides better economics. The capital not tied up in land can be deployed toward equipment, technology, or reserves that improve operational performance. Lease when flexibility is paramount. Younger farmers building operations benefit from the ability to scale up or down without being locked into owned acres. Farmers approaching retirement may prefer leasing to avoid the complexity and risk of late career land purchases. Negotiate leases creatively. Cash rent provides simplicity but transfers all risk to the operator. Flexible leases based on yield or revenue share risk between landowner and operator. In volatile economies, flexible arrangements often work better for both parties than rigid cash rents. Selling land is one of farming's hardest decisions, often resisted for emotional reasons even when economically sound. But strategic selling improves financial health in several situations. If land values are at historic highs relative to income potential, selling captures that appreciation. The proceeds can pay down debt, build reserves, or purchase different assets at better prices. If land is marginal or requires excessive inputs relative to production, selling and redeploying capital into better land or other investments often makes sense. Holding every acre out of tradition or emotion can trap capital in underperforming assets. If debt service on land is consuming operational cash flow and creating stress, selling enough to right-size debt often saves the remaining operation. Pride prevents many farmers from selling any land until forced to sell everything. Strategic downsizing preserves core operations, maintaining liquidity and reducing risk. Regardless of ownership versus leasing strategy, maintaining liquidity and managing risk are essential for surviving volatile economies. The most resilient farms share common practices that transcend the ownership question. First, maintain substantial working capital reserves. Target 30 to 50% of annual operating expenses in liquid savings. This seems excessive, but provides the buffer that allows riding out bad years without defaulting on obligations. Asset-rich, cash-poor operations are vulnerable regardless of how much land they own. Second, avoid using operating lines of credit to cover losses. Operating loans should finance inputs for a single season, repaid at harvest. Rolling operating debt year after year signals that operations are unprofitable and changes are needed. Papering over losses with more borrowing accelerates the path to crisis. Third, stress test financial plans against adverse scenarios. Model what happens if land values drop 30%, commodity prices fall 40%, or yields decline 25%. If any single scenario creates insolvency, current strategy is too risky. Adjust leverage, increase reserves, or improve operational efficiency before crisis forces changes. Fourth, diversify income sources to reduce reliance on single commodities or enterprises. This doesn't require completely different businesses, but some mix reduces concentrated risk. Farms with crops and livestock, multiple crop types, or supplemental income from custom work or agritourism weather downturns better than single enterprise operations. Fifth, maintain strong lender relationships and communicate proactively. Lenders prefer working with transparent borrowers who identify problems early and propose solutions. Farmers who hide problems or avoid communication until crisis is imminent often find lenders have no choice but to force liquidation. Sixth, revisit ownership versus leasing decisions regularly as circumstances change. The right strategy at 35 differs from the right strategy at 55. Economic conditions shift. Family situations evolve. What worked 5 years ago may not work today. Rigid adherence to past decisions prevents necessary adaptation. Finally, recognize that land ownership is a means, not an end. The goal is sustainable, profitable farming that supports families and communities over generations. If leasing accomplishes that better than ownership in current circumstances, leasing is the right choice. If ownership provides stability that leasing can't, then ownership makes sense. The question isn't which is inherently better, but which serves the farm's long-term health given specific conditions. What the smartest farmers are doing now? Looking at successful farms today reveals patterns in how they're navigating the ownership versus leasing question in current economic conditions. These patterns provide guidance for others making similar decisions. Many established farmers are selling some owned acres at current elevated prices, paying down debt, and leasing those same or similar acres back. This captures land appreciation, reduces leverage, and maintains operational scale. The shift from ownership to leasing transforms illiquid equity into liquid capital while preserving production capacity. Young farmers entering agriculture are increasingly focused on building operational skills and cash reserves before attempting land ownership. They lease for 5 to 10 years, prove profitability, accumulate capital, and only then purchase land selectively. This patience prevents the over-leveraging that destroyed previous generations. Mid-career farmers are buying selectively when opportunities arise at reasonable prices, but only with substantial down payments and conservative leverage. The aggressive expansion mindset has been replaced by measured growth, prioritizing financial stability. They're more likely to buy 80 acres debt-free than 400 acres at 70% leverage. Farmers approaching retirement are increasingly selling land to the next generation on contract rather than gifting or leaving it through estates. This provides retirement income while giving the next generation time to pay from farm earnings rather than requiring immediate financing. It also avoids family conflicts that destroy farm continuity. Family farm partnerships are structuring land ownership separately from operations. Parents retain land ownership, providing retirement income through rent, while children own the operating business. This separates asset ownership from operational risk, protecting family land even if the farming business struggles. Conservation easements and land trusts are being used strategically. These tools reduce land values for estate tax purposes while generating income and maintaining family control. They're not suitable for every situation, but provide options for farmers worried about estate tax burdens on appreciated land. The common thread across these strategies is intentionality. Successful farmers make deliberate choices about ownership versus leasing based on their specific situations rather than defaulting to conventional wisdom or emotional attachment. They adjust strategies as circumstances change rather than rigidly maintaining past approaches. Recap: land ownership versus leasing has shaped farm survival across every economic crisis. From the Great Depression through the 1980s to today, moderate ownership with conservative leverage provides stability, while heavy ownership with excessive debt creates catastrophic vulnerability during downturns. Leasing provides flexibility and liquidity but less long-term wealth accumulation. Asset-heavy farms prioritize land accumulation but sacrifice operational flexibility. Cash flow-driven farms maintain liquidity through leasing but forgo appreciation, wealth building. Modern forces like inflation, interest rates, investor speculation, and climate change complicate these decisions. The best time to buy is during downturns with conservative leverage based on production fundamentals, not market speculation. Leasing makes sense when building operations, when flexibility matters, or when prices are inflated. Selling at peaks or to right-size debt preserves financial health. Maintaining liquidity, stress-testing scenarios, diversifying income, and communicating proactively with lenders builds resilience, regardless of ownership strategy. The smartest farmers today blend approaches, make intentional choices, and adjust as conditions change, recognizing that land ownership is a means to sustainable farming, not an end in itself. Outro: if this exploration of land ownership versus leasing strategies gave you new perspective on building farm resilience, give this video a like and share it with anyone navigating these critical decisions. Subscribe to Farmtips Diary for more insights on managing farm finances through economic uncertainty. Hit that notification bell so you never miss strategies that could protect your operation's future. Thanks for watching, and we'll see you in the next one.